All right, so let's dive into some of the best ETFs to invest in for 2025. We're going to be looking at buystocks.ai. What do they think are going to be some of the best ETFs moving forward? So they rank the Invesco QQQ Trust, which everyone just calls QQQ, as the #1 ETF. It's known for outperforming the S&P 500.
It is, yeah. And one of the reasons for that is because it's very heavily weighted towards technology stocks. I think it's 60% tech stocks.
Oh, wow.
And then another 20% consumer discretionary. And you think about the big names like Apple and Amazon and Tesla, all of that's going to fall in that bucket.
So if you're really liking where AI is going and cloud computing and all that, QQQ would be a way to get in on that.
For sure. And they've had a great 5-year return, like an annualized return of 18.8%, which is incredible.
That's amazing.
Really good.
And pretty low expense ratio, too.
Yeah, 0.20%.
So that's nice.
Yep.
So the next one that they're looking at is the Vanguard S&P 500 ETF, which is VOO.
VOO, the classic.
Yeah, the classic one. Broad market exposure with this one.
Exactly. So this one is tracking the S&P 500. So you're getting 500 of the largest U.S. companies, very low expense ratio.
It's a good one to just set it and forget it.
Yeah.
14.3% annualized return over the last 5 years. Yeah, very good.
Solid. Now, this next one's interesting. It's the Schwab U.S. Dividend Equity ETF, or SCHD.
Okay.
And I like this one because it seems like it's a blend between growth and income.
Yeah, this is a good one for people who want some stability and some dividends. So focuses on high-quality dividend-paying stocks.
Yeah.
And has a really strong dividend yield of 3.6%.
Oh, nice. And a 12% annualized return over the last 5 years.
That's really strong, which is really good. And then 0.06% expense ratio.
Yeah, really good combination of growth and income.
Yeah.
And low expense ratio and stability.
Yeah.
Which is what a lot of people are looking for these days.
Especially now. So for all the tech enthusiasts out there, we've got the Vanguard Information Technology ETF, or VGT.
All the tech.
All tech.
Yep.
So this is Apple, Microsoft, NVIDIA, all the big names.
Yeah. So if you want to be invested in the technology sector, this is the ETF to do it.
Yeah. And it's done very well, a 21.45% annualized return over the last 5 years.
Wow.
And 0.10% expense ratio.
Not bad at all.
Not bad.
For that kind of growth potential.
International diversification is very important as well, and that's where the iShares Core MSCI EK ETF comes in, or IFA.
IFA.
Yeah.
So this one focuses on developed markets outside of the U.S.,
Okay.
so Europe, Asia, Australia.
Got it.
So if you want to diversify globally, this is a good way to do it.
Yeah, it's important to not put all your eggs in one basket, as they say.
Yeah, for sure. Especially in the U.S., we tend to be very U.S.-centric with our investments. And so it's important to remember there's a whole world out there.
There is a whole world out there. And 6.2% return over the last 5 years.
Not bad, yeah.
Which is good.
Yeah, that's really good for international exposure.
All right, so moving on to real estate, we've got the Vanguard Real Estate ETF, or VNQ.
VNQ. So this one gives you exposure to U.S. REITs,
Okay.
which are real estate investment trusts.
Okay, so like owning a bunch of different property.
Exactly. So it's a way to get exposure to real estate as a tangible asset class.
That's a good way to hedge against inflation.
Yeah, and it can provide some diversification in your portfolio.
2.4% annualized return over the last 5 years. Not as high as some of the other ones, but it's all about that balance.
It's about diversification.
And the diversification.
And a 0.12% expense ratio. Not bad at all.
That's pretty good.
For real estate exposure. Now let's look at bonds.
Okay.
Specifically, the iShares 20-plus year Treasury Bond ETF,
Okay.
or TLT.
DLC, got it.
So this gives you exposure to long-term U.S. Treasury bonds, which are, generally seen as a safe haven asset,
Right.
especially in times of market downturn or volatility.
Yeah, makes sense.
It's not necessarily going to have those huge returns. The 5-year return is actually negative 3.39%.
Yeah.
It's not always about the return. It's about managing risks.
Right. Capital preservation.
Exactly.
Very important.
And the expense ratio is 0.15%.
Yeah,
So
not bad.
pretty low.
And now, whether you go with one of these really growth-heavy ETFs like QQQ, or something a little more stable like VOO, or even bonds like PLT, dollar cost averaging is a good strategy.
Yeah, dollar cost averaging is a great way to invest in ETFs, especially for the long term.
Especially for the long term.
Yeah. Instead of trying to time the market, you're just consistently investing over time. And that helps you to average out your cost basis and reduce your risk.
Yeah, it takes the emotion out of it.
Exactly.
You just put in X amount of dollars per month or whatever your cadence is.
Yeah.
Thanks for joining us, and we'll see you next time.